how to improve your credit score. Today, we're going to talk about the bureaus, what you can actually do to increase your credit score. I'm going to show you real life examples of what it would do if you paid something off or if it was 30 days late, be able to see the score change. We're going to talk about credit utilization, the credit score buckets, the different kind of score buckets as it relates to buying a home. And then I've got a bonus tip for you, the 45-day credit rule that you're going to want to stick to the end to find out more about. So let's get into it. Talk about how to improve your credit score. If you can check out the channel, click that like button, click that subscribe, and click that bell icon. I'm putting out weekly videos, tips just like this of how to buy a home, real estate market, mortgage interest rates, all kinds of good stuff. So let's talk about first and foremost the three credit bureaus. The three credit bureaus, and I'll put it right up here above, but you've got Experian, Equifax, and TransUnion. These three credit bureaus, privately owned, have their own scoring model. So you're typically gonna have a different score from each one. So what do lenders look at? We look at the middle credit score of the three. If there's multiple borrowers, we're typically looking at the middle credit score of the lower borrower. So 720, 730, 740, 750, 760, 770. We throw out the high-end borrower. We look at the 720, 730, 740, and we select that 730. That is not me talking. That is literally the mortgage industry, underwriting, everything that you can possibly think of. This is the standard. This is the norm of how you get a credit score and what lenders use to be able to look at it. Next, I want to go into kind of second topic here is a real life example of what it's like if you paid something off and what your credit score does. So as I take you onto the screen here and we look at how basically a high credit score only has one available account out there. And you can see as I'm changing this around from going down just a little bit, and I'm keeping that credit utilization. If you see that number there, I'm keeping that above 15%, then we're not finding much difference in increase in rate. Then if we get that credit utilization below 15%, that's when we're seeing the biggest kind of increase in your score. And as we want to talk about this credit utilization, I also want you to see what happens when you don't pay something on time. So as you can see here, when we actually have a late payment, in this case, we're going in from the 780s down to 720. We've got a 60-point drop in the credit score just by making one late payment on a credit card. So definitely prioritize. Even if you just get the monthly payment paid on time, prioritize getting that paid on time to ensure you don't have a late payment. Now, let's talk about this credit utilization term that I was speaking of. As you can see here, credit utilization is basically the largest portion of a credit score. Now, what does that actually mean? Let's imagine you have $1,000 on a credit card and you use $900 every month, but you pay it off. In this case, you're using 90% of your available credit. Your credit score is likely going to be going down or staying stagnant because you're using a very high percentage of the credit that is available for you. That's credit utilization. If you're only using a very small portion, in this case, or in this last case, you saw under 15%, we saw some huge increases in the score. So that is definitely one of those plateaus. So my tip for you here is making sure, even if you're paying it all in full or you're paying it off or whatever you may be, if you're carrying balances, just don't get close to the top end of the credits, of the maximum line of the credit card. Installment loans, you just need to pay those on time. Those will basically help you increase your score. Even if you have, say, a car loan or whatever else, and you've only made one payment, it's brand new, it's still going to help your score as you make installment loan purchases. It's the credit cards or revolving lines that we're talking about today. So next I want to kind of take you on and let's talk about the credit score buckets or the different kind of top and bottom of where these credit scores are at. As you can see, the different percentages of where the average American has a credit score. Now, as it relates to mortgage lending, typically around that 580 to 620 would be the minimum for most loan programs. And that's probably a little bit aggressive. A lot of banks might be 640 or 660. So, in terms of can I get a loan, man, you got to have it start with a six. If you have it start with a seven, if you have a 700 or above, you're absolutely going to have a loan program that's going to fit. Now, obviously, you got to get credit qualified to be able to understand what you can do and if there's options for you. But in terms of just pure credit score, absolutely you're going to meet the minimum threshold, right? So these different score buckets, these are very important when it comes to a mortgage loan. This is the absolute biggest piece to the puzzle when it comes to what mortgage rate you are getting. Super duper important. If you check out the video I did last week, mortgage rates today, I actually went into a little bit of how the credit score changed. If you do the drop down and say, hey, I got a 700 score, a 720, a 780, a 680, you can see the difference in interest rate could be 1 to 1.5% different just from the credit score. All right, now let's talk about the bonus tip, and that is the 45-day credit rule. The 45-day credit rule essentially is the CFPB, Consumer Finance Protection Bureau, a government entity. They are there to regulate mortgage lenders along with a bunch of other things. But they have a law that says if you get your credit pulled within 45 days of the original credit pull from a different lender, it only counts as a single inquiry. Let me give you an example. You get your credit pulled from lender A, lender B, and lender C. That's one inquiry as the scoring model takes into consideration. Now, does that single inquiry potentially bring your score down just slightly, maybe a few single points? Sure, absolutely. But if you got it pulled a second time or a third time or a fourth time, as long as it's within that 45-day period for a mortgage transaction, then in these cases, you only have one single inquiry. This allows you to shop for that mortgage loan, be able to find the best program, rate and terms, mortgage lender, loan officer, all those things. If you walked into a bank, you'd have one, or credit union for that case, you'd have one rate. You have one 30-year fixed program, one underwriting policy, typically just one way of doing business. And someone like myself is a hybrid lender where we're using our own money and our own resources. I might have 30 to 50 different programs that I could be kind of shopping around for you on, right? With that one credit score. But if you're finding you walk into the bank and whatever else, then absolutely, positively, you want to get a second opinion because it could be drastically different than if you were working with someone like me or a hybrid lender or a mortgage banker. Then in these cases, we do get to kind of shop that around and find potential different scenarios for you. So something to keep in mind, and that bonus tip is you need to understand that you can definitely have your credit score pulled. If you have a lender that tells you you cannot get your credit score pulled, like say you're going to get pre-approved, do not have your credit score pulled, or your pre-approval could go away, or credit score will be down. They don't know the rule. You shouldn't be working with them straight away. If they don't understand what the law says and what you can and can't do, or they're lying to you if they already know, then you absolutely shouldn't be working with them. So if you made it this far in the video, hit that subscribe button. Thank you so much for tuning in. Happy holidays. Stay safe, and we'll see each other again very, very soon.